at the end. I feel like I want to go on. But this is the final bit. The last few concepts that I'll be sharing with you. Um, and this is on international capital market inflows and markets. And here I'll be talking about international capital inflows, really important theory in economics, the theory of uncovered and covered interest parity, and foreign exchange crises. And then I'll be finishing with capital controls. It's been great doing this video. I hope you've enjoyed it. I hope the next time that you're debating with your friends, a house party or in a bar, or sort of having these economic debates at some kind of gathering like Nigerians typically do. We're always debating about the economics. I hope that you'll be able to be more informed and use some of the terminology. And the next time that you're watching the economic analysis on TV, I hope that you'll be able to understand more of the terms that people are using. That's really the goal of this video. So we're finishing off with the final unit. And you can see a lot of containers here. Looks a bit like a papa, but slightly more uniform and organized. And papa is like the biggest port in Nigeria for those of you that are not Nigerians that are listening to this video. So that's really the evidence of the amount of international trade that we do. So the first concept that I'll be talking about is covered and uncovered interest parity. And this is for people that invest in Forex. So the Forex market is like tons bigger than the market for actual goods and services. People trade Forex all the time, and the biggest Forex trading centers in the world are places like London, places like Singapore. Are the biggest Forex trading centers, and there are two ways to trade Forex. You either do spot transactions or you do forwards. And the whole idea, or part of the idea of making money from Forex, is to try and predict what the exchange rate is going to be in the future. That's something that you have to take into account. And then people try and invest in currencies that they feel, even taking into consideration movements in the currency, would give them a better interest rate than if they kept the money in their home currency. And this is what covered interest and uncovered interest parity refers to. So covered interest parity, it considers a situation where an investor is investing in a foreign currency with the exchange rate locked in by a forward. So a forward is an instrument where you can lock in an exchange rate with the financial institution that you're investing with, so that you get something guaranteed. And uncovered interest parity is when forwards aren't used to lock in the exchange rates. So uncovered interest parity actually says that currencies with high interest rates should see their value depreciate and therefore not offer superior performance. But this doesn't really hold up to empirical testing, and that's why people trade in Forex, because when you look at it empirically, which some people have done, it shows that actually currencies with high interest rates tend to appreciate. So a lot of Forex is traded around the country, definitely more than the trading goods and services. And there's two uncovered interest. There's two things that economists talk about: the covered interest parity, which is when a forward is used, and the uncovered interest parity when there's no forward use. Forex crisis. The funny thing is, right, the international audience might not really know as acutely as Nigerians the effects of a forex crisis. Man, that thing is painful. When you have a foreign exchange crisis, and there's sort of two schools of thought, or two types of thinking regarding foreign exchange crisis: first generation thinking and second generation thinking. The first generation thinking blames the governments for conflicting fiscal and exchange rate policy. So when there's a forex crisis, Um, it says, the government is the only person at fault. It's the policymakers' fault that a forex crisis has occurred. But the second generation thinking is more nuanced, and I think it gives us more scope because that highlights the role of foreign investors and their expectations in terms of whether a forex crisis occurs or not. And this is like so important in terms of what the country's reputation is, because there's no such thing in economics or finance as a debt level that is the internationally accepted debt level where a country defaults. It just depends on what foreign investors think and what the narrative is around the country at the time. Um, I think there was a debt to income, a debt to GDP ratio of 60% set for EU countries. But, some EU countries have debt to GDP ratios of over 100%, but people still see them as good economies to invest in. So, the role of foreign investors and the financial system and the faith of the financial system in the country and the leadership is super, super important. That role of signaling, that role of body language, is something that I guess we've just started to realize in Africa. But it's such an important part of stability beyond the numbers. Yeah, my last slide on capital controls. So, capital control represents any measure taken by a government or a central bank or a regulatory authority to limit the flow of foreign capital in or out of the economy. So, they're trying to control the balance of payments by not letting too much capital go out of the country. It may also restrict the ability of domestic citizens to acquire foreign assets, and that's referred to as capital outflow controls. So tight controls are found in developing countries where you don't want people messing about too much with the capital reserves, the amount of capital in the system, because it's lower and it can become more volatile.